Now, market structure. What is it? The market move in two ways. The market move either upward or downward. When the market is not trading up or trading down, it's called sideways. It's called consolidation, where the market is quiet. So I'm going to show you an example. Number one, we have a market that moves up like this. And we call these uptrend. Uptrend. Okay? Write it down. It's very important. Uptrend. Then there is a market that moves down. Sorry. Let me delete that. There's a market that moved down. You see it coming down. All right. Come down, come down, come down. Like that. Come on, man. Like that. So we have the market that trade down. Okay. Trade down. Okay. We see trade like this. I'm trying to arrange it so you understand the structure. Okay. Let's leave that alone there. Now, this kind of market is called the downtrend. It's called downtrend. Downtrend. Write it down, please. Downtrend. Okay. That's the type of market. This market trade down. It's called downtrend. Then there is a moment where the market is not trading either up or down. And that is called sideways market. It goes like this. And we call this consolidation. Consolidation. It's called consolidation. Let me just type because this pen is not helping me. So I'll type so you can get it. So this one, we call it the uptrend. Uptrend market. Okay. This one is called uptrend market. And this one is called consolidation market. That means the market is moving up and down, no proper direction. And this one is called the downtrend market. Okay. Now, the question is, what kind of structure should I be looking for? How should I trade this kind of market structure? How? How should you trade this kind of market structure? First of all, it's to understand what they are. Whenever the market is moving up, it creates a structure called the higher highs and the higher lows. Write it down. So the market will create higher highs. This is a high, but it pushes up to create a new higher high, HH, and then retraces back. This is called retracement. When the market pulls back to take a break, it retraces back and then creates what we call a higher low, and then pushes up again to create a new higher high. Why? Because this high is higher than this high now. And then it retraces back down to create another higher low. Why? Because this high is lower, is This high is lower than this high, and this high is higher than this low. You get it? This low is higher than this low. So it's called higher low, higher low. So, but this one here, we know that this one is lower than this. This one is higher than this. So you see the structure keeps just repeating itself until another new higher high opens. So in an uptrend, we have this structure: higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Then in a downtrend is the opposite. We have something else. We have first a market creating from upside, and then it's creating a high here, and then creates a low. And the next thing is to push up to create what we call a lower high. And then it pushed down to create a lower low, and push back up as a retracement to create a lower high, and push back down to create a lower low, and push up again to create another lower high, and push down again to create a lower low. That's where we see a downtrend. This is the structure of a downtrend. So a structure of a downtrend is a lower high, lower low, lower high, lower low, lower high, lower low. Don't forget, I'm singing it now so that you remember. Even in your dream, you'll be able to remember it. Lower high, lower low, lower high, lower low, higher high, higher low, higher high, higher low. Now, that is uptrend and downtrend. But when it comes to consolidation, where the market is creating equal highs and equal lows, we call it consolidation. And this market, we don't advise to trade it, because you have to know what you're doing to be able to trade this market and be successful. A lot of people lose money trading this type of market, and because they don't understand market structure. So we encourage, as a beginner, start looking for uptrend and downtrend market to trade. You say, would you ever find it? Of course. Let me show you how it is traded. Number one, you see a market pushing up, and you wake up and you saw it's pushing up, and next thing you find out that the market is pushing back in, is retracing, is creating a red candle, from green candle to red. And the next thing is it stopped at a position, and then it start pushing up with green. Oh, that shows you a structure there. And then it push up again to create a new one, a higher high. So now you have a structure. So at this moment, you're not saying, okay, now I see what this market is doing. The market has created a high and created a higher high, a higher low. Now it's creating a new higher high. So what am I going to do? Since the market is creating a new higher high, because it's already pushed past this one, it's creating a new higher high. You wait now for a lower high, a higher low to create, sorry. You wait for a lower high, a higher low, which is HL, a higher low. So you wait for this market to pull back into the zone, and then you have a trend line. We'll talk about that later. All right, we'll talk about that later. Okay, then what happens? You get in for a buy. Put your stop loss here, and your take profit will be over there. Why? Because it's going to break this high anyway. So you take trade, you buy from here. Just see, this is how you trade, is uptrend. And then whenever the market is retracing back, you get out. Wait for it again to retrace, and then look for a buy opportunity here again, and you take it up again. You just keep trading it. So as an uptrend trader, you are buying what? The higher lows. You buy the higher lows. Some people say the higher high, but I don't advise it. That's risky. Be patient and wait for a higher low to form and buy it. The same thing goes with what? With this downtrend. The same thing goes with the downtrend. Did you guys just got what I said? The same thing go with the downtrend. So with the downtrend, what do you wait for? You sell the lower high, you sell the lower high. You do not buy the lower low or sell the lower low. You sell the lower high. Why? The market structure is clear. Market is trending down and then it stops. It creates a pullback. That's where you sell. You sell to sell a lower, to sell to a lower low. You sell your lower high to a lower low. So while the market is creating a lower low, your trade is in it. You get the idea now? Your trade is in it. And then you pull back in again, bam. And then you sell again here at the lower high. And then your trade is in it as it's going down. Now, this is called the impulse move. Impulse move are rapid. It's called aggressive move of trade. The aggressive, zim, 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 aggressive. Correction is the pullback, the retracement. It's called correction. It's called pullback, retracement, correction. And they are very slow. And they come very dented. It doesn't move fast. So you want to follow where the impulse is, where the main market is moving towards where the volatility is the impulse. This move down there. When it's trending down, you trade with the trend. Have you ever heard anything like that before? Trading with the trend? The trend is your friend. This is what it means. You trade the impulse. You trade the impulse. Buy the impulse. Wait for it to come back. Buy the impulse. Wait for it to come back. Buy the impulse. Wait for it to come back. Buy the impulse in an uptrend. Then in a sell trend, wait for it to come. Wait for it to pull back. Sell it. Wait for it to pull back. Sell it. Wait for it to pull back. Sell it. But in this kind of consolidation market, you don't have the opportunity, except you have experience in the market. You cannot trade support and resistance, support and resistance. So you buy the support, you sell the resistance. 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 So your target is always either the support or resistance. Your target is always either the support or the resistance. Now, having explained all of these market structure, which is very important for you to know, the next thing is we're going to look at the chart and then we'll take questions. Wow! Let's look at the chart. Ready? Okay. Now, firstly, this is a very big time frame. So let me shift that. And we'll go to the daily. Let's look at the daily time frame. All right, let's look at the daily time frame. This is the daily time frame. Wow, look at the GU is selling crazy. Crazily selling. I missed that opportunity. This is the sell I was waiting for. Well, let's go. Let's go. Let's go. Let's go. We have to do this, right? Next week, maybe we'll have the opportunity to do this. Let's sell it. Okay. Now, just a good example of a downtrend. Can you guys see a downtrend? Already now, can you recognize this is a downtrend? I need an answer in the box, in the chat box. Come on, come on. Somebody keep me alive here. Come on, give me energy. Give me some vibes. Can you see it? All right, all right, all right, all right, all right. Let's look at the structure right. So now we see that price began to drop. All right, we see a downtrend, a clean downtrend. From uptrend, oh, what an example is this? From uptrend to downtrend. So let's look at this. I want you to mark this. Whenever the market is moving from a trend to another trend, the next thing he does is to consolidate. Market don't just switch from trend to trend. If it's going to switch, it's going to consolidate. So you will have these three patterns of structure in the market. Number one, you will have consolidation. This is a consolidation. And then this is a trend. here. And then this is a trend here. You see the three types of market? Now let's analyze it. First, we have market came all the way down here and then created a push-up. So we can have a trend line here to show us that it's an uptrend. So what does the market do? Started creating a higher high. So first, the market created a low here, created a high here, and pushed back down to create a higher low, push up to create a higher high, came down to create a higher low, push all the way up to create a higher high, came down here to create a higher low, and then consolidated along the way to create a bigger higher high. And what happened? The market came down to create a higher low and then created a push-up, but this time equal high. So that was a consolidation. No phase. Equal high, equal high, equal high, equal high, consolidation. So this whole box was a consolidation. Why? Because the market is reversing. How did we know? The market failed to create a bigger high that will take off this high. You see it now? The market failed to create a higher high to take up that high. So what happened? The market is changing structure. So the market created a big low. Okay? From here, we see markets changing structure. Break out of this consolidation zone, retest it, all right, by creating what? A lower high. And then the market pull back in by forming a pattern. This is called M pattern, all right, but with a lower high still. So we have two lower high with a higher low, but it failed to break this high. So this is where you see reversal pattern. I'll talk about that in an advanced class. So this is a reversal pattern, okay? How do you know a reversal pattern? When the market creates a new low and it creates a new higher low and then fails to create another higher low. But listen, it's too complicated. I don't want to go into that one right now. So I don't want to confuse you, okay? Let me stop there for now. But look at it. The market created a lower high, a lower low, and push up again to create a lower high. And the next thing, it dropped massively, created a lower low, push up again to create a lower high, and then drop again to create a lower low, and push up again with a lower high, drop again with a lower low, push up again with a lower high, drop massively, lower low, and push up right now with a lower high. Where are we in the market? The market is struggling to create a lower low. This is GU. You see that?